Hey everyone, I'm Tom Schmidt. I'm a general partner at Dragonfly Capital. We're a global crypto venture fund.
Yeah, I'm Arthur. I'm the founder and CIO of Defiance Capital. We run a liquid crypto fund right now.
Santiago, run my family office, been in the space, ex-Verify.
Hi everyone, my name is Tushar. I'm co-founder and managing partner at Multicoin Capital.
And I'm Pranav Khanade. I run VanX Digital Asset Alpha Fund, which is a liquid token strategy. So mine is Santi. I'm sure a bunch of us get this question from LPs all the time, which is, why should I deploy capital into your strategy over just buying Bitcoin? Because the reality is in the last 12 months, Bitcoin's up like 120%, and then you've had the general altcoin market that's only up around 50. So maybe that's a good place to start, which is what's broken in the token markets? Why are alts not trading as people would expect, which is at a beta to Bitcoin? Maybe Tushar, you can get started at that.
I think the reason to deploy to a manager instead of buying Bitcoin is if you think that manager is going to do things that you can't do, right? Yeah. So you should go buy some Bitcoin directly. And I think it doesn't really make a bunch of sense to go pay fees to a manager to go and like hold a bunch of Bitcoin for you. Like, it doesn't. Why would you do that? So I think selecting liquid funds based on their non-Bitcoin exposure is probably what I would do as an allocator. And I think the second part of your question was, why are alts underperforming Bitcoin? And I think that's generally just risk-off atmosphere. Hopefully, we see that turn around with rate cuts and liquidity injected back into the market. But I think it's very much driven by liquidity.
Yeah, I think we talk to LPs and ask a similar question. Tell them you should be buying Bitcoin. It's like if someone coming to you asking about equities allocation, you want to tell them put it all into venture. It's like, yeah, go buy some QQQ. Go buy some S&P. And I think there is value in having kind of like a more of a barbell distribution. I agree with what Tushar said. Like, ideally, if you're allocating in a venture, it should be doing so in a manager that sees something or can do something differently than what you would normally be doing, and maybe learning in that process. As far as why alts aren't performing, I mean, I think it's actually very bizarre. Like, if you look at the dollar amount or sort of the FDV of alts compared to something like Bitcoin, compared to something like global crypto markets, it's actually quite small. So you don't really see this wealth effect that we've seen in previous cycles of Bitcoin going up, ETH going up, and then sort of that flowing into alternative assets. So something feels very broken there. I think more often it's more just a lot of these products aren't novel. They're not solving a real problem. If you look at sort of on-chain metrics, they're really just like dismal. And so I think projects that have done something new this cycle actually have done pretty well. And we've seen new top 100 coins from this launch or from the past 2 years. But it's very rare to see that. You generally find one team that makes a kind of one-of-one breakthrough. And that's kind of it.
Yeah. I think every manager have a slightly different strategy when it comes to liquid. And for us, I think we are just better than most of the market at picking the token that will outperform. And we obviously have the track record and the skill set to demonstrate it. And I think that's the kind of pitch that every manager will say. And I think on a broader picture perspective is, if you're investing beyond Bitcoin, your belief is ultimately crypto is not just Bitcoin. And the growth of the other non-Bitcoin asset will eventually catch up. And I think that's the thesis for why all of us are in this industry. And for why the token have underperformed, I think one big factor is the past few cycles, a lot of the performance are over-indexed on whether the retail will buy the coin. And what we realized is this cycle, the retail didn't come back in the same time frame as compared to Bitcoin. Bitcoin hit all-time high, but the retail have not really come back just because Bitcoin hit the all-time high. If you look at Coinbase volume, the institutional volume of Coinbase have fully recovered compared to 2021 peak, but the retail is still trading at around quarter of the previous all-time high volume. So the retail, by almost all data, is just not anywhere close to the 2021 level. And the second thing is there is a big mismatch in the capital allocated for public market versus the venture market. Roughly, the capital allocated to crypto venture funds are 3 times of crypto hedge funds. And beside this, there's no other like structural buying pressure for most of these altcoins. Like the project are likely gonna sell when the unlock start to fund their operating expense, and the VC might take profit if they're up a lot. That's in their fiduciary duty. Yeah, and who's there to buy besides the retail? I mean, there's just not enough capital in the smart money, like liquid hedge fund side.
Yeah, I think to add a couple layers to what you're saying there, I remember when Multicoin raised its first venture fund in 2018, and it was a small vehicle. And I think in general, it was very hard to raise capital in that 2018-19 timeframe for venture funds. And you had this crazy bull market in 2020, 2021, where the influx of retail capital was enormous, and that created this big altcoin season. Part of that was, retail had stimmy checks, had compounded that wealth through the equity markets, eventually made its way to the altcoin market. And you kind of saw this bull run play out, and everyone's got this expectation of the same thing. I think this time around, retail is broke, and you kind of can explain some of that through like meme coin season, right? Which is the retail that is in crypto is trying to hit a quick 100x in something, and is not trying to really focus on a real thesis or at least a medium to long-term thesis. Could that come back? Probably, is my guess. Retail will come back at some point. The other thing I think that's interesting is, my team and I did this study, research project, whatever, which is really ask when's the optimal time to invest in a token project. And we concluded that it's probably 12 to 18 months after a token launches, largely because you've gotten enough tokens vested in the market from the founders and from the original investors, and there's enough supply out there where you're getting a reasonable price, or at least a more fair price in the market. And you also evaluate whether the founders and teams have executed against that roadmap or not. So now I look at that and I say that's more of a crypto-centric problem, which is how tokens are launched, but also how vesting works. It takes a very long time for price discovery. So maybe the question is, A, do you agree with what I'm saying? And B, what's the answer to that problem?
I think there's a fundamental misalignment between venture and public markets, where venture investors think long lockups are a good thing because they signal alignment, and it signals that you're in it for the long term, the team's in it for the long term. And if you're a public market investor, you see low float, high FDV, you're going to be selling this thing for 6 years. And that disconnect is really tough. And right now, we are seeing the projects that raised money in 2021, 2022, and that peak hype cycle go and have TGE. And this disconnect is becoming more apparent now because you had these inflated 2021 valuations with long lockups, and the public markets are just not buying it. They're saying, I'm not in. I will wait, and maybe once you're done with your lockup, I'll be interested. So I think time heals this. I don't know if anything else can.
There's simply no liquidity entering the market. I mean, the thing I track the most is stablecoin supply, and that's been fairly muted. So as long as that continues to persist, there's no demand for tokens. Any interest from retail has gone to meme coins, particularly enabled by Solana. And so the whiffs of the world are attracting the lion's share of the liquidity. And candidly so, I mean, I think the meta really just changed where people are not buying Filecoin, people are not buying these. But back then they would, now, and you could argue what's changed because there were meme coins back then. It's just more, I think, the ease by which you do it, using something like Phantom, mobile has become a big part now this cycle. Something like Jupiter, really, Solana really has allowed retail to express their views on chain, whereas before it was much more difficult in prior cycles. So why would you buy a high FTV unlocking token when you can go and buy a meme coin? And I think retail really appreciates that.
Tushar, I heard you on a podcast recently where you talked about Solana's Cliff Vest and how that might be a potential alternative to this linear vest that people do. Mm-hmm. How do you sort of think about that? Maybe you can talk about why Solana might have done that when they launched in 2020 and why that might have led to some of sort of the traction they got from a community perspective.
Oh yeah, this is a fun story. So I remember when Anatoly called me and he said, everyone else is doing these extended vesting periods, and I don't want to do that. I just want to do one cliff and get it behind us and move on. And my initial reaction is, you're crazy. No one does it this way. Like, why are you trying to be different? But he explained his logic. He really wanted to have real price discovery. And he was like, if people want to sell, they should sell. And if people want to buy, they should buy, and we'll see what the price is. So they set up a 9-month cliff from TGE. I remember TGE was like April, and then the cliff was in January in 2021. And I don't know if you remember what the Twitter timeline was like going into that unlock. This was like peak ETH maxi FUD on Sol about how the circulating supply was going to explode and the price was going to crash. But as it turned out, having price discovery and having the tokens out there and giving the market certainty about what the supply is really worked. Also, we got lucky on timing, right? Like that unlock happened at exactly the right time, and I don't want to underplay the amount of role that luck played. But what are the lessons we can learn from that? I think the lessons we can learn from that are, one, public markets want you to get the float out there. We run a big public market hedge fund, and one of the first things I look at is the float to FTV ratio. And if that's a low ratio, I'm like, I don't care what the number on the screen says. This isn't a real price. It doesn't matter. So I think public markets want your float to be out there to see what the real price is. And second, I think founders should feel locked up because of ideological reasons, not contractual reasons, right? Like, you want founders who wouldn't sell other than, they need to like pay bills and stuff, but they just so much believe in what they're doing that they're in it for the long term, and you don't need a contract to know that. So I think look for those types of founders.
I mean, the benefit with Solana is that they had a very healthy secondary market. So a lot of those tokens were traded before that event. And so that, you could argue that teams that allow for that to have investors step in ahead of that and have an orderly price discovery ahead of the unlock, you place a lot of those tokens in hands that are willing to hold it for longer, is very healthy. And I think we should, I look at stable secondary market activity as a primary indicator of, is it going to be a bullish unlock, not a bullish unlock. And most of the times when teams don't allow for transfers, it creates a very disorderly unlock. Whereas if you do allow them, it actually is very muted after the fact. And so we should focus on secondary market activity, and a healthy secondary market is a really good indicator.
I think for every one Solana bullish unlock, there's probably about 100 down only destitution zone unlocks. And I do think you have to worry a little bit about being a statutory underwriter if you're sub 12 months in the U.S. and therefore as a VC potentially looking at liability. And two, this is kind of a tried and true path for startups in the traditional path, right? Like we mandate founder vesting for any single company that we work into, and if you don't have that, similar to locks, like you generally don't have that same kind of alignment. Sometimes you find a once-in-a-generation founder like Anatoly, like Raj, and great, independent of what any sort of legal contract says, they're going to be long-term aligned and holding. But again, I think that's rare to find, and I also think it's rare to find that in investors that are going to have that conviction, that are going to be with you for the long term. I think in some ways the crypto public markets is like, it's almost like a bizarro world version of what the U.S. equities markets would look like, and if the IPO market looked up, and I think in traditional venture. Funds are not returning any DPI. They're not going out to raise. New fund managers from kind of that 2020 vintage are basically totally screwed. And I think in crypto, obviously, the process of launching a token is not nearly as arduous as going through an IPO, which I think is actually good. But the downside is you get this much greater dispersion in terms of outcomes because you don't have those sort of not guarantees, but at least some sort of level of quality when people are actually coming in and buying a token.
I think going back to the topic that what will fix this broken market issue, one is for the token to really be more linked with the success of the project, which is something that we have not seen in many projects. And even right now for, let's say, Ethereum, the biggest debate is always that, does the success of Ethereum as a technology and platform equate to success of ETH as an investment, as an asset? And then if we are asking ourselves about this same question to ETH, this is a more bigger question for almost every other crypto startups out there with a token. And obviously we know the regulatory issue that's preventing this from happening, but I think if projects are a lot more serious about linking the relationship of the token and the success of the project, I think this will in some way change the broken token market. But I think one issue is also good discussion is we are all investing in growth in crypto. So what do you think about like protocols that still have a lot of growth potential ahead, but they should return some value to token holder via buyback or just outright distribution, so to keep the relationship stronger? Because in traditional finance, they don't have to do that because you know that shareholder right exists legally, but in token, there's no legal right. So you're basically only believe in the relationship if you get a cold hard distribution in like cash or whatever form of the revenue. So I think that's kind of the key issue that need to be fixed if we do not get the capital imbalances between private market and public market fixed. Yeah.
So your question is, should token projects return capital to the token in some shape or form, right?
Yeah.
Yep. I mean, I'll take a shot at this and then maybe we can kind of go around. But like intellectually, I'm like opposed to that idea because these are like startups, and like we never asked Amazon or Apple or whatever to give capital back in like the 90s and 2000s, right? Apple only started giving, doing share buybacks and dividends in like the late 2000s after like Icon showed up and told Tim Cook, you got to do something. So to like ask these projects to return capital back, that's kind of like taken away from capital they can keep internally and reinvest in things and building more useful things, especially if it's a great team. Like that's what I intellectually believe, but more operationally or just sort of like realistically, at least in our team, what we say is like, who's the next buyer for this token? And oftentimes it's like, well, we have to believe retail is going to have interest in this token, but we also have to believe that's going to drive the token to like a top 10, top 5 token at some point that TradFi will come in and buy it one day. But even to get retail's interest, you need something. You need a natural buyer. And in this market, it seems like the natural buyer is the protocol itself doing a buyback to support the price, right? So I'm like kind of torn between the two things.
Yeah.
I don't know what you think.
I'll take the other side of that. I think tokens should absolutely be, or teams should absolutely be trying to drive value back to the token from the beginning. Even if they could reinvest that in growth, I think the way to solve that is have some of that cash flow go to buy and burn the token, but have a variable issuance rate. So you can actually issue more tokens to stimulate the growth, but show capital markets from the beginning that you are serious about sharing the value with token holders and show that cash flow flowing back through a burn mint equilibrium or some other burn mechanism or a distribution, whatever the mechanism. I don't care what it is. But I think set the precedent.
I mean, you're the pioneer of burn and mint, and it's one of the most complicated token designs I can come across. I mean, it's such a complex idea. Do you think most people would understand how it all works? Or they just understand price go up?
I feel like this is the IQ chart meme, right? Where someone on the left and on the right is like, this is great, and someone in the middle who's doesn't love it. I think it's pretty simple. It's you have an emission amount of tokens. You have tokens being burned. If you have more emissions than burns, the price goes down. And if you have more burn than emissions, the price goes up. And like that's about as far as most people need to think.
I do think, on the margin, the amount of overall, burns for someone like Maker, for example, that does actively, obviously, buy back its own token is pretty small compared to, the overall float of the asset and volume for the asset as well. I think you make a good point, though, around being able to mint new tokens and use that to kind of finance the project. this is something that we just have not really seen done recently, and I think this is part of the reason why there's such a capital allocation mismatch between public and private markets. If you're a traditional company and you're issuing equity, you can authorize issue new shares, sell those in order to raise new capital from the public markets. That process is extremely complicated or maybe even impossible in crypto public markets. And that's why we see teams go through these convoluted treasury sales, try to hit up VCs, sell these big discounts. In theory, these teams should be able to issue new tokens, sell them on the market, use that to recapitalize themselves. But we haven't seen that. And I think that's, again, a byproduct of kind of the regulatory environment. In the US, is a lot of teams just don't want to touch that with a 10-foot pole. But I think that would obviously help normalize these markets and sort of I think the market tends to be pretty smart and sort of respond to the right incentives. And right now, there just isn't enough incentive to tap into the public markets, which I think is causing this sort of weird bifurcation.
Maybe to switch gears a little bit, there was a Twitter post, X post, whatever, that went viral recently around quiet quitting or founders and teams quiet quitting. And I'm sure we all talk to different founders, different teams all the time. Curious to hear about how prevalent you think this is, how much of a problem this is, and maybe then we can talk about what do you do if you see that happen a lot.
Yeah, it's definitely. I think there's a very big difference between skeptical and cynical. The longer you stay in crypto, the higher the probability that you become cynical, or you become a Bitcoin maximalist again, because you see a lot of nonsense in the space. You see not very competent teams get away with stuff, and then you see the teams that are trying to really do good stuff and hard work be totally overlooked. There is an element of the best tech sometimes doesn't always win. Distribution matters a lot. It's a very retail, attention-driven market. So you have to play the game, but you see it every cycle. I don't think today is any different than what it was, back in 2017. It's just the way naturally, survival of the fittest. 99% of teams are, mediocre or not going to survive. And crypto is very difficult. I think what my appreciation is, building in the open, building in crypto introduces a layer of complexity for founders that, because you have a token, if the token is going up, people are obviously, that's your job. If the token goes down, they blame it on the founder. And so Kane, the founder of Synthetics, has a great line. He says, look, if you haven't been called a scammer, you're not trying hard enough. And I think so. So I think you can kind of try to piece together why people are quitting. One, it's not easy to build, again, but I would emphasize that it's not different this cycle. It's a natural kind of state of startups, and most end up failing.
Yeah, I think this exact same phenomenon happened in 2019, but no one wrote posts about it or called it quiet quitting. But yeah, people naturally respond to incentives, and if there's not momentum, if there's not capital, if there's not really an opportunity for new talent to come into the space and feel like they can build something and have a great outcome, I think they're just not going to, and people are going to leave. And I think a lot of the people I met when I got into the space in 2017, who left in 2019, they never ended up coming back. And I think that's I empathize with that decision, in that if you're a new entrepreneur and you think about where do I want to be spending my time, you look at crypto, people are going to make fun of you. Someone might try to throw you in jail or hit you with a absurd lawsuit. And I think it's really unfortunate that the government can have such a negative impact. And ultimately, I don't think it deters or changes the destination of where this technology is going, but it can greatly kind of slow it down. And I don't think growth is something that's guaranteed or we sort of take for granted. You can see how a really negative regulatory environment can tamp out innovation and sort of kill companies. We kind of saw that in the EU, and I'm worried that that's kind of happening this time around, where at a certain point the momentum kind of starts to go backwards.
I think a big part is we haven't seen big breakout new use cases, and anyone who has spent more than 5 years in this industry was hoping for a shorter time frame for us to hit mainstream adoption in some use cases. And I think a lot of people came in with very high hope last cycle, and it didn't deliver against their expectations. So this quiet quitting thing has been more prevalent. And I think it's also possible that the industry in the short term have kind of hit its cap in terms of how much capital and talent it can accommodate for the use cases make the most sense. And I think that we just have to accept that the industry might not be worth like 10 trillion in the short term, but we will get there. And it's just like a short-term adjustment the industry will make.
I also think there's a realization amongst investors and teams that value will be more concentrated at the top than we might have expected in 2021 or 2022. And I think that leads to some of this quiet quitting or just general disillusionment amongst a lot of people, because people like to win, right? And when it feels like the giants are just going to own everything and you're going to be a small cog, because it's so hard to make money in crypto. I think one of the big things that blockchains do is they destroy margins. Your margins go down. Everything is permissionless. Everything is open source. It's really hard to defend your margins. And that's why I think when founders start out, they don't necessarily think about the longer-term margin defensibility. They're not thinking about longer-term competitive landscape. But then when they're faced with that reality and they see, I'm going to be, one of 1,000 projects that, is on whatever page of CoinGecko, not on the first page, right? Like, it's discouraging. As to what we do when we see someone quiet quitting, we sell or we write it to zero. That's about all we. You can't make someone do work.
Well,
but
so
I
point,
would say I would argue the premise that it's really hard to make money in crypto. I mean, you have incredible distribution, attention, and you have businesses like Pump.Fun, whether you like the business model or not, that is just a cash flowing machine. And so if you're a builder, if it's your first cycle or you've been here for many cycles, I would argue that you look at that and you can only be inspired by that type of scale that you're able to get in this industry. Now, the question around retention is a good one, which is how do you maintain that flywheel going and attention and fees? But I don't think that is like the reason why people are quiet or soft quitting. I guess the question is, would you say that most people are quitting? Are those founders that came this cycle? Are they founders that have been around for a long time? Is it particularly more pronounced in an area like DeFi that's been kind of left for dead? I'm just kind of curious, as you look through your portfolio, is it kind of more acute in one area versus the other?
Well, since you brought up Pump.Fun, maybe I wanted to touch on that real quick. You probably believe Pump.Fun's a great product, great for Solana, right?
Full disclosure, I'm an investor, so.
You are, okay. Yeah. Well, what do you think? Is Pump.Fun net positive for Solana over the long run?
Yes, absolutely. Because now there are all these people with Solana wallets that previously did not have Solana wallets.
Yeah.
And that's the number one metric that matters, is the number of people who have funded wallets on your chain. I think that's the most important metric for demand side for a blockchain ecosystem. And the most important metric on the supply side is developers building unique things. None of this copy pasta, we're borrowing this concept from old Ethereum L1 and putting it over here. That I don't think counts. I think that's the more valuable insight on the supply side, is you need unique teams. Is Pump.Fun unique? I think so. I think they found some unique gaming mechanics, and they're very transparent about what the product is. They're not. It's not like they're trying to promise you, oh yeah, this meme coin's going to cure cancer, or this thing is going to create zero-knowledge proofs that change the world, or this is layer 45 scaling, right? Like they're like, no, this is fun. Yeah. Guess what's going to be popular?
I mean, Las Vegas, Macau, like. Yeah. We don't seem to criticize those particular industries, entertainment, as much as memes, but it's the same expression. I think people really appreciate the directness and transparency of something like a meme coin. You know that it's gambling, you know the casino, you know the rules, and there's something about that when the rules are very clear and the game is very clear. People tend to like that. When it's not, then you get the disappointment.
Well,
Yeah, one thing I'd add, just real quick. I think the reason why people like meme coins is more institutional traders don't have an advantage. Because the whole game on meme coins is guess what's going to be popular. And like, I don't know, I can't speak for all you, but like I have no idea what's going to be popular, right? So I think retail is playing against each other in meme coins, whereas I do think I can underwrite a token project better than most retail. So I think I have an edge there. So I think that leads to the rise of meme coins.
Well, the only counter argument against this would be, how do we tell the boomers this is what crypto is being used for, right? Like, the question I often get from, again, the boomers is, whoa, Solana is doing really well. What's going on there? What's interesting? And I'm like, oh, there's this awesome casino called Pump.Fun. And that's it, really. But I don't know if you ever answer that question, or how would you answer that?
I think we are stress testing the rails for DeFi. And what I hope to ultimately see, and the reason why I'm in the industry, is I think these are the right rails for financial system to run around the world. But that's not going to happen overnight. We need to see lots of activity. We need to see money. We need to see all the shit break, right? And we've seen that happen because of the pressures from these meme coins and this trading activity. So I think that's what's exciting.
I'll take a more pure view of that. You know, what really drove some of the advancements and adoption of the internet? It was the porn industry. And, you know, there's people that don't like that. There's people that have a problem with that. But at the end of the day, you know, it's, you know, when you think about crypto, I think as an industry, we really feel this need to be very defensive because you either love crypto or you hate it. It's very bipolar. So when you go and talk to people in traditional markets, you know, you most of the times become defensive to try to justify the existence of this industry. So putting Bitcoin aside, I don't have any problem now telling people that this is a casino, that there is a hyper-financialization happening. And I think the more that we understand and accept that, I think we're better off as an industry. We don't need to be defensive. We don't need to justify that we are speculating. Speculation drives innovation. It's really hard to predict how this technology, much like the internet, is going to be used. No one could have predicted that. They didn't do it in 2001 with the internet. They're not going to do it here. But to Tushar's point, I think there's something really powerful about tokenizing attention, about allowing anyone to be a market maker or provide liquidity to earn fees for that consumer preference to really, to really have like transformational business models. Like we haven't even talked about Deepin. But fundamentally, I think all of these different iterations are opening up and capturing the imagination of people of what it means to be an owner in a network, to participate in the upside. And I think that really transforms the relationship that people have and how they think about you know, accruing value for their contributions. And if you're not excited about that, then you should go do something else, and that's totally fine. You'll come back in 10 years.
Yeah, I think you guys said it well. I think the only thing that actually like irks me is when I think people try to intellectualize meme coins and tell me a greater story. It's almost like you know, being very literal and heads up about it. I think is almost more noble. And you know what? I don't think there's anything wrong with having porn on the internet or you know meme coins on chain. Makes sense.
Maybe to switch gears a little bit. What do you guys think about the U.S. election? It's it's a question I get a lot when I meet people. You know, there's like this institutional crypto manager survey that maybe a bunch of us take part in. One of the questions is like, what do you think the market will do if Trump wins? What do you think the market will do if Kamala wins? It's basically, people generally think market goes up 30%. If Trump wins, Kamala wins, market's down 30, right? That's where like people believe, or at least say they believe the world's going to shape up. So how are you guys managing risk, or how are you even thinking about this election?
We were joking ahead of time that in venture, you don't manage risk. You know, it's a little bit of the same old, and we're kind of just deploying and trying to find teams. And I think, you know, obviously trying to find good opportunities in the market. But I think, if anything, the election is bullish. I think base case, Harris wins, and we're sort of where we are right now, right? I think, you know, the GOP still takes the Senate, and I just don't think there's going to be any momentum or any sort of movement when it comes to regulation in the U.S. You know, best case, and you get a more, you know, favorable office, I think great. That's only sort of bullish for the industry. And so I really don't think it's harder to get worse than where we are right now. And I think that's going to be sort of the stagnant nature of sort of a post-election U.S.
I don't think it matters, candidly, very marginally. I think what is most important is, I think we've peaked in terms of, when you think about the evolution of crypto, the hostility is sort of like 2012, it wasn't important, it was too small, no one really cared, and then as more value started to be created, there was more attention, and then my argument is that we've sort of peaked on the level of regulatory hostility towards the industry, and it happened right before the ETF was approved. I think we go down from there. Now, I think there's two different ways that line and that progression happens. In one administration, it sounds like it would be much faster than that. Whereas the other, it may still be things don't change much, but the level of hostility, I think, is not going to persist to that degree, for the simple reason that you have an ETF, and I think Wall Street for the first time is able to make money off of this industry, and that is pretty important when it comes to how we think about just the existence of this industry and the justification of having regulatory clarity, like policy making. Like we need guidelines. That's the most important thing, and these things certainly take time, and to work their way through Congress and be socialized within the different committees. And in many ways, I used to think that we needed them like 5 years ago, we need them 3 years ago. But if you look at how the music industry was regulated at the advent of things like Spotify, these things take time, and we, in many ways, I'm glad we haven't really crystallized them. I think it's time now to do that, and I think someone like Larry Fink and the Wall Street kind of apparatus really kind of pushes us closer to that. Hopefully it happens within this administration, but I don't think, as I said, I think we've peaked, and so it's largely irrelevant who wins in my mind.
To your point, if someone told me in 2020 that a presidential candidate was going to launch a DeFi protocol, I mean, I wouldn't have believed it, right?
Exactly.
I think from a practical short-term perspective, it is very important, and most managers, I think, will lower their net exposure going into the election, unless you're like the very long-term kind of strategy. Because I think crypto has never been so intertwined with politics before. So this is a new development, and market wouldn't be very certain on how to make of the impact from a short-term perspective. So I think, yeah, you're going to see a delta of 20% in crypto market cap as a result of who is becoming the next president. That's just on a short-term price action. And I actually think the long-term impact is even bigger. But that's not what the market in short-term are able to figure out. But in short-term, I think the difference is 20% in market cap. In the long-term, I think it matters even more. I think one thing a lot of crypto natives don't realize, because we are generally more libertarian, we don't try to play the politics side, is the industry have gotten big enough to impact like national security and all the other stuff that even normal people will care about already. And this is something new to us, and politics start to matter. And actually, you look at every other industry, when they were small, the government doesn't care about them. But when you get a certain size, you always need to deal with politics. And let's look at tech industry in China and US. I mean, when you hit a certain level, politics is actually matter for the next level of growth. And I think crypto is close to that level already. So I actually think the long-term implication is more than a short-term 10-20% swing in the market. But
I'm going to put you on the spot since you mentioned a percentage swing. So Kamala wins tomorrow, market's down 20%. Are you a buyer?
Depends on who she appoint as the next SEC president. So you need to see like the candidate choice for all this kind of members she appoint, right? Yeah. If she turns out to be not as hostile, then yeah, we buy. Yeah.
I'm definitely a buyer. Like, look at all the what makes a democracy great is the judicial, like the checks and balances of power. Every single court case of crypto, the major ones, have ruled in favor of this industry. Don't forget that.
I know, but I think it doesn't matter because it's not feasible for every company to go and fight a lawsuit with SEC. Only a few companies with the legal resource can master this fight. Most companies are going to settle. And you're not going to get a very favorable result. Yeah, it's not practical to go for a lawsuit with the government on every cases.
Yeah, I'm more with Arthur on this. I think it does matter, but I don't think it's a death blow or anything like that. I do think that having a friendlier administration will enable more experimentation and new business models, and it'll accelerate innovation. Or we kind of stick with the current pace of innovation, because that's the status quo. Right now, we have a very hostile administration, and a continuation won't kill the industry. But what I'm looking forward to is hopefully seeing an acceleration due to a more permissive regulatory structure. I do think we need to separate the word crypto here into two components. I think Bitcoin is separate. I think it doesn't matter which candidate wins, Bitcoin is going to do well because both of them are going to blow up the budget deficit. No one has any plans to fix it. No one is even going to try. And we have to remember, what Bitcoin was created for is an escape hatch from the fiat system. So I don't think the election matters for Bitcoin at all. I think we're talking about all the other assets.
And to your point, I think I'm going to close with that. Someone sent me an estimate of each candidate's policies and how much it adds to the deficit. I think Kamala's number was 6 trillion and Trump was like 7. So
yeah,
that's your Bitcoin thesis right there. Cool. Well, thank you. I think that's our time.
Thanks.